All right, today we're going to play financial detectives. We're not looking at flashy profits or new products. Nope. We are digging for clues in a place that almost everyone ignores, a company's liabilities. Let's get started.
Seriously, just think about this for a second. Because, the most telling stories about a company's real risks, about the integrity of its management, they're often tucked away in the fine print of its debts. And our number one suspect is a liability called a provision.
So, what exactly is this mysterious liability that's kind of lurking in the shadows of the balance sheet? Well, it's time we dragged it out into the daylight.
Okay, so a provision is basically accounting speak for, hey, we definitely owe some money because of something that already happened. We're just not 100% sure when we have to pay it or exactly how much it's going to be. Think about stuff like future warranty repairs, a lawsuit that's still in court, or the cost of an environmental cleanup. The obligation is real, but the details are fuzzy. And this idea of certainty is absolutely key. On one end of the spectrum, you've got your trade payables. Super simple. You get an invoice from a supplier for a set amount, you know exactly what you owe. Rock solid. Provisions, though, they live right in that murky middle ground of significant uncertainty. They're way more real than just a what if, but they're a whole lot less clear than a simple bill. And that right there, that's why they're so important for us to look at. They are a hotbed of management judgment and estimation. Now, a company can't just create a provision out of thin air whenever it feels like it. There's a very strict set of rules that accountants have to follow. Think of them as our 3 golden rules of the investigation before anything can be put on the books. These are the 3 pillars, the 3 boxes you have to tick. First, there has to be a present obligation that came from something in the past. The company can't just be planning for some future expense. Second, it has to be probable that money will actually leave the company. And third, you've got to be able to make a reliable estimate of the cost. If a company fails on any one of these 3 points, no provision can be recorded. Period. Now, that first rule gets into some really interesting territory. See, an obligation doesn't have to be spelled out in a legal contract. If a company has, for example, a famous, long-standing public policy of giving full refunds, no questions asked, or if it's publicly announced a major restructuring, it has created what's called a constructive obligation. Its own actions and its own words have created a duty that it can't really escape. And this is where things get fascinating, especially if you're looking at companies around the world. That word probable, it means 2 different things. Under international rules, IFRS, it just means more likely than not, so a better than 50% chance. But under US GAAP, the bar is set way higher. We're talking something like a 70 or 75% chance. Now, think about that. An investor could be looking at a US and a European company, and the exact same lawsuit, with, say, a 60% chance of being lost, would create a provision for the European company, but it might just be a little footnote for the US one. Same facts, totally different financial picture. Okay, so once an accountant decides a provision is necessary, the next big question is, how much? This isn't just a wild guess. There's actually a science to the estimation. The main goal is to land on the best estimate. Now, for something that covers thousands and thousands of items, like product warranties for a big electronics company, they use a statistical method called expected value. It's a fancy way of playing the odds. They look at all the possible things that could go wrong, no defects, minor repairs, major replacements, and they weigh the cost of each one by how likely it is to happen. So for instance, a company might figure out there's a really small chance of a super expensive recall, but a much higher chance of some cheap, minor repairs. They crunch all those numbers, weight the probabilities, and boom, they might land on a final provision of, say, $70,000. It's how you turn a whole bunch of future maybes into one solid number on today's balance sheet. But, and this is a big but, with great judgment comes the potential for great mischief. The uncertainty that's built right into provisions can be exploited. And that leads us to one of the oldest tricks in the accounting playbook, the cookie jar. This quote just nails it. Here's how the crime works. A company is having a fantastic, record-breaking year. Management might be tempted to get a little pessimistic about future costs and create an extra large provision. They are literally stuffing some of today's profits into a cookie jar reserve. Then, down the road, when they have a bad year, they can just reverse the part of the provision they didn't use, which releases those old profits back into the current year's income, making a bad year look pretty good. It's a classic way to smooth out earnings and hide volatility. So, as our financial detective, what clues should you be looking for? Well, first, be really skeptical of massive, vaguely explained provisions that just happen to pop up in amazing years. And this is the big one: read the footnotes to the financial statements. If you see a company that seems to always be reversing old provisions right when they need to hit an earnings target, you might have just found a hand in the cookie jar. Look, this isn't just textbook theory. The story of provisions has been front and center in some of the biggest corporate disasters and scandals you can think of. Remember the Deepwater Horizon oil spill? BP had to create a massive provision for the cleanup, the fines, the lawsuits, the whole shebang. Their initial best estimate was a jaw-dropping $20 billion, but that was just the beginning. As the years went on and the true cost became clearer, that provision had to be revised up and up and up again. It just shows you how enormous and how volatile these real-world estimates can truly be. And we saw the exact same story with Volkswagen's Dieselgate scandal. At first, the provision was just for fixing the cars. But as the full global scale of the fraud was uncovered, that provision more than doubled to over $18 billion. You can literally watch the financial story of the scandal getting worse and worse just by tracking the growth of this one number on their balance sheet. So after our whole investigation, what's the big takeaway here? Why does digging into this seemingly obscure corner of accounting actually give you a real edge? At the end of the day, this is why provisions matter so much. They're like a window into a company's soul. They show you what management really thinks about its future risks. When you analyze them carefully, you can judge the quality of a company's earnings and the prudence of its leadership. It takes you from just being a passive reader of numbers to being a true financial analyst. You now have the detective's toolkit. You know the rules, you know the red flags to look for, and you know just how high the stakes are. So the only real question left is, the next time you open up a financial report, what hidden stories, buried in the liabilities, will you be the one to find?